welcome back to another edition of Financial Accounting. A couple things I want to go over just looking at the calendar. Today is April 21st. We'll finish up. I want to revisit a little bit about 10.2 today, and then we'll jump into 10.3 and probably talk a little bit about 10.4. Homework for 10.1 and 10.2 is due tomorrow. So we're kind of ahead in the lecture circuit here. So just kind of be aware of like the timing, what's going on. 10.3 and 10.4 will be due on Sunday. The next week we'll start jumping in with chapter 11, and that will be our last full week. Hopefully we can get through a lot of the material early. My goal is to try to get you guys some information about the final exam either Friday or Saturday. Just a lot of people have been asking me, hey, what's going to be on the final exam? And we've sort of talked in class that we know that our final exam, unfortunately, is right here, 7:30 a.m. on May 11th, and that's going to be a 50-question exam, 2 points each, or 100 points total. About 20 of those is the chapter 10 and 11 material. So obviously that's the stuff that we're going through right now, and that's why the homework is crucial, that you do that and you make sure you understand what's going on. The other 30 questions will be the previous material we've looked at. So anything that chapters 1 through 9. But I don't recommend people go back and redo everything. I'm going to have a set of notes, review notes, that will tell you what sort of learning objectives to focus on specifically. So you can go back and just look at those particular topics. And even within those learning objectives, look for the micro topics, the stuff that was emphasized the most in those specific learning objectives. So let me get those notes up to you. Just realize for right now, chapter 10 and 11, obviously you're going to nail that stuff. So we're going to focus on that. Let's see here. So we might be able to start the review even as early as April 30th, Friday, April 30th. But we're getting close. Things are moving along pretty quickly. The accounting cycle extra credit project, a lot of you had done it, and I have uploaded your points on Blackboard. So you can have to scroll a lot. When you go to My Grades in Blackboard, you have to scroll pretty far towards the bottom, right where it says extra credit assignment, score points earned. So you have as much as 20 points max, and a minimum 14 points. So I've uploaded those based on your performance. If you have any questions about that, you can just let me know. And if there's something looks weird, happy to go back and take a look and just double check to see if it was uploaded properly. So I encourage everybody to do that. Go back and take a look at that stuff. We stopped, we actually went in this class all the way through the material, but 10.3 and 10.4 talk about preferred dividends. And so I want to kind of go back and just talk about preferred stock for a moment here. Preferred stock, you don't see it very much. You don't see preferred stock actually on companies' balance sheets very much. Some companies do issue preferred stock. It's different in the sense that that kind of stock is not the type of stock that people want to hold on to if they want to control the business. Control happens with common stock. So preferred stock, all you're really doing is giving some people preference for getting their dividends. So it is possible, though, that if there is preferred stock, you'll still see, a preferred stock T account like you would a common stock account. It looks very similar. And there might be a preferred stock additional paid-in capital for any amount that people paid above and beyond. Again, not too common to see that, but it would still act in similar fashion, accounting-wise, as you would see with a common stock. So that being the case, preferred stock does pay dividends, but it has a payment preference of dividends. People who have preferred stock, they're first in line to get their dividends when the company declares them. So preferred stock, like I said, we went through some of the features. It's possible that preferred stock has very unique features in the sense that we can offer a conversion feature. So kind of like bonds have a conversion feature. You can trade in your bonds and convert them into common stock. So if you want to go from being a debt holder to an equity holder, that conversion feature is available. Excuse me. This is slightly different. Preferred stock is an equity account, but it's not like really that people own the business or control the business. They just have a type of equity called preferred stock. If they want to convert it to common stock, so that way they have, say, voting rights, for instance, they will do that. Sometimes we offer a conversion feature for preferred stockholders. So if that's the case, we issue, let's just say, 5,000 shares at $1 par value per share, so there's no APIC, additional paid-in capital. We would just go ahead and record that journal entry and plug in into the preferred stock account. We probably call it convertible preferred stock. We plug in that credit for whatever the par value is. And then down below, we said, hey, look, if this does have a conversion feature, what's the math I need to do? Well, generally, the ratios you see you're given is a amount of preferred shares you need to trade in per one share to get one share of common stock. So we kind of went through a little bit of the algebra and the math there, but essentially what you want to do is take the 5,000 preferred shares that are out there, multiply them, or excuse me, divide them by 6.25 to determine how many common shares. So we can take 5,000 preferred shares and give these preferred shareholders 800 shares of common stock. It sort of looks like they're kind of being ripped off. They're not. When we issue common shares, there's a lot of power that people have when they own common stock. So trading in preferred shares, you may have to trade in a little bit more to get one share of common. Rarely do you see a one-for-one type of conversion. Usually you have to pay, trade in a bunch of shares, preferred shares to get common stock. But if we do, we're just emptying out the preferred stock account. And then from there, the question is, okay, part two is there any par value of common stock? If it is, what do? We multiply the par value times the number of shares we've issued. If there is another credit that we need to balance this out, it's just going to go to a paid-in capital account or an additional paid-in capital account. Additional paid-in capital, it's the terminology is just there's some other reservoir account that where we put in the excess, and that's why sometimes they call it excess over par, paid into capital. So those are the journal entries. That's how we would make this sucker go down to zero, and then all of a sudden now those preferred shareholders are now owners of the business. Preferred shares rarely have any type of ownership rights associated with them. So preferred shares is obviously different than common stock. There's another type of stock that potentially a company reports, and that's called treasury stock. Now this sounds kind of weird, like treasury. Well, like what are we, pirates now? Is that booty? Is there a treasure chest? What is it? Treasury stock. The word treasury is sort of a broad term. And essentially it represents, the treasury is like the finance management, the financial management of the company. So most companies, like big companies especially, like if we're talking about Nike has a lot of different divisions and groups within the corporation. And they obviously have their manufacturing or their management wing or whatever. But they usually, big companies, even like Microsoft, will have a finance division or a finance department. So these big companies, they hire finance majors because, hey, we need somebody to help us manage this $8 billion in cash that we have lying around. If you go work for Amazon or Starbucks, they're going to have a finance department. So these companies are known for, like, say, in the case of Starbucks, Starbucks' ticker, by the way, is S-Bucks. S-Bucks. So you can look them up. Starbucks is known for coffee, but of course the corporate side of things, how they manage the company, they're going to have a finance department. Outside of any type of bank or financial institution, they'll have these finance departments. But banks, if we're talking about, say, for instance, Bank of America or U.S. Bank or whatever, any type of bank also has a finance department. But if you think about it, banks are all finance. They're in the finance sector. So do banks have what's called a finance department? No, they have what's called a treasury department. And the treasury department it acts similar to what we would see in the finance department of other companies. They just manage the cash that's on hand. So when I went to work for Washington Mutual, I worked in their treasury group, the treasury department. And that's where we managed the cash funds that we had. And we had certain investments in stocks and bonds from other companies and other types of securities. So I got to learn the ins and outs of finance in great detail by working in the treasury group. Treasury group is just another way of saying the group that manages all the stockpiles of cash and investments. So we're talking about treasury stock. We're basically saying it's the company's way of managing its own stock. But in this case, when we issue stock, what happens after it's out around in the stock market trading? Well, we as the company, the ones that issue the stock, we can own our own stock. In other words, we can invest in ourselves. It sounds kind of weird, but can I go with me here? It's stock that we had issued previously, but now we decide to buy it back. So there's a variety of reasons why we might want to buy back our own stock. Okay. Maybe we need the stock to distribute to our employees as a form of stock grants, right? In other words, we don't want to have to reprint new stock certificates because that requires us to do the preemptive right and all the other stuff about we need to worry about diluting other people if we're issuing brand new stock. If we have an agreement to give people stock as a form of compensation, let's just buy our own stock out of the stock market and just grant it or give it to our employees. Maybe our stock is trading really low, and we're looking at saying, we have a lot more value than what currently stockholders are viewing our business as. So we might want to buy our stock, pull it out of the market. And when we do that, it's like supply and demand. Like this is our supply curve, right? If we buy back our stock, we're pulling the supply out of the market. We're shifting the curve to the left. And all of a sudden, now you can see that stock price, where it was maybe right here, is now going up to a higher amount. So we can buy back our own stock. And by doing that, we will automatically raise the price of the stock price of our stock. That can be a good thing. Avoid the hostile takeover. We see that if we have too much stock out there and people are gobbling it up to try to take control, maybe they want to be a 5% holder, 20% holder, we might want to pull that out of the market. The thing is, we can increase our earnings per share. Earnings per share is our net income divided by the number of shares outstanding. So if we take this denominator and we shrink it, we bring it down, we shrink that overall denominator, what happens to the overall earnings per share? Well, you get this shares outstanding. Basically, the overall ratio goes up higher. And people look at that and say, wow, higher EPS is generally a good sign of financial health of the company. That can be a reason why we do this. Repurchase program to return excess cash to shareholders. Maybe we just, we have this agreement to basically, and this is usually what you see in private companies, is they have some stock of our company and we work with them directly to buy back their shares at some sort of premium. In other words, return some capital to them. You don't see that too often. Usually what we're talking about here in corporations, we're talking about the stock market deals with that kind of stuff. When we buy back our own stock, when we repurchase our shares, the amount of shares outstanding decreases and the number of shares issued stays the same. So recall from I think we talked about this previously, that there's shares authorized, issued, and outstanding. And usually the amount that we authorize can be something ridiculously high. We determine that when we form the company. The state says, how many shares does the board authorize that this company can issue at the most? We can say something like 25 billion, or we can say 50,000. It's up to us, like some higher upper bound ceiling. What do we actually print is what we issue, and whether or not that stock is still being held by outsiders, it just depends. If we buy back our treasury stock, right? So here's us, the company. When we initially issue the shares, individual holders have it, but at that point we can say number of shares issued equals number of shares outstanding. But if we decide to go out to the stock market and buy some of our own stock back, we can buy them from existing shareholders. So you could have the number of shares issued be higher than the amount of shares outstanding. So if we issued, say, 1,000 shares, but we bought back 200 from the market, we hold 200. The rest of the outsiders hold 800 shares. So the amount of shares outstanding in that case is 800 outstanding. Shares issued stays the same because those certificates are considered live. But that's what we're kind of dealing with here is we want to buy back our own shares for whatever reason. What's the accounting that we have to do with that? Well, we have to report this on the balance sheet. How we report it looks kind of weird because you see down here, the treasury stock at the bottom there, it's shown as what looks like a negative number. Essentially, it's not really a negative number. It's an offsetting contra account. Here's the shares that we have issued. These are the shares that we've totally issued. Of those, we've bought back some treasury stock. And granted, that doesn't seem to make sense. How could we buy back more than we issued? This was when we initially issued, well, this is Home Depot here. When they initially issued, this was an IPO they did decades ago. So the price, the amount of cash they got was something very small relative to today. If they issued stock today for the first time, those numbers would be much higher. So decades ago, Home Depot issued this treasury stock, but they bought back some of the shares at the current share price, which could be obscenely high, granted. But in this case, we need to make sure it shows up as an offsetting account, because the amount that we've issued is one number, but how much of that has been brought back, that's what the treasury number is representing. So the stock is still considered alive. The amount of shares we've issued is still alive. The only difference is some of it is held by outsiders, and the other portion of it is being held on the inside. The portion that's held by outsiders is considered outstanding. That's why we call it outstanding stock. If we buy back our own stock, what's the accounting that we have to do? Realize in this case that we're going to be paying cash almost always to buy back our own stock. So we're always going to be crediting cash. Typically, we'll buy it back at whatever the stock price is currently trading at. So here we said that we have 1,000 shares of stock outstanding. It's $1 par value. It's currently being traded at $7 per share. That's the market. Now, this is where a lot of people make a mistake on the final exam. When we buy back the stock, we're not going to debit the common stock account, right? The common stock account has some sort of balance. We do not debit that account when we buy back our own stock because the stock is still alive. We leave that alone. We come up with the treasury stock account, in which case we say of this amount that we've issued, we have this much that we bought and pulled out of the market. So this treasury stock account is quite literally just a contra account that we just need to keep track of. It's just meant to offset the other paid-in capital accounts. So we're not debiting common stock. We're just going to debit treasury stock as a contra account. The contra account is a debit. That's why it shows up as a negative number on the balance sheet, because it's meant to say, here's an offsetting balance from the overall paid-in capital account. So when we do that, realize we're leaving this stuff alone. We don't touch this. We're just plugging in whatever the balance is as a debit to treasury stock, crediting cash. That's step number one. We pull that in. Question comes down to, what are we going to do with it now? What can we do with it? We can do a lot of things. So option A, we retire the treasury stock, which is to say we're really kind of just retiring the common stock. There are certificates that are alive and we want to cancel them. We want to burn them up. We want to toss them, whatever. So if we decide to take all these certificates and throw them in the fireplace, in other words, retire them or cancel them or delete them, get them out of the registration, okay, we can do that. And if we do that, we just need to empty out, realize we're emptying out the treasury stock account with a credit. So down below, that $7,000, we're just going to credit that to make it go to zero. Okay. Those shares have been burnt in the fire. They've been retired. What else do we need to do? Well, for every credit, we need a debit. For every debit, we need a credit. In this case, we're actually getting rid of 1,000 shares of this stock that's been outstanding. So it was alive. Now we're killing it. How many shares are we killing off? 1,000 shares. So if we retire it, then we will debit the common stock account, any type, as well as any type of associated paid-in capital. So up above, I think in the previous example, we were saying that they tell us what it was original issuance was $4 per share. So there was $1 par value, and let's see, additional paid-in capital was $4. So when we initially issued this thing, we had got a total of $5 from the market per share. Okay. Now we're saying we want to get rid of this, get rid of the $1 per share, and get rid of any $4 per share that's been attached to these, because we're just burning them up. So down below, it shouldn't be like 40. That should just say 4. That shouldn't be 10. That should just say 1. What the hell is going on? What was I smoking? It must have been 420. That was yesterday. Common stock was $1 par per share. That is now been burnt up, so we get rid of 1,000 from the par value account. There was, when we issued these things, each share had a $4 per share additional paid in capital. We're getting rid of that too. So these shares, when we buy them, there's a history that's being stamped on these things or kept track of by us. The 7,000 we paid, that's just how much, that was a $7 per share when we bought it. But when we look at these, we say, there was a time when we first issued these, it was $1 par value and we got another $4 of additional paid in capital. Let's cancel these. Let's retire these, which means get rid of the history, erase the history, empty those amounts out. Okay, we're going to reduce the overall common stock account, reduce the overall APIC account. Those shares are gone. Those amounts need to be reduced from the common stock and the additional paid in capital account. If there's another balance, if there's another debit or credit, this is the thing you just need to realize for the final exam, is that there's probably going to be some sort of plug figure to retain earnings. So we paid 7,000 for something that initially had a $5 kind of baseline value to us. If we need another 2,000 debit to make this journal entry balance, plug that in last. So in this case, I always recommend emptying out the treasury stock, then go through and figure out what was the original par value and additional paid in capital associated with those shares, get rid of those amounts, and then third, figure out if you need another debit or credit to retain earnings to make the journal entry balance. If we do that, then we have just that extra. So it can be complicated, but just realize ultimately that from an analysis standpoint, we paid $7 per share for something that had essentially a cost basis, if you will, cost basis of the 1 plus 4, the par value plus APEC. So the overall cost basis of these was $5. That's because that's what we got when we initially issued them. We bought them back at 7. They have a cost basis of 5. When we burn them up and get rid of them, essentially that gives you an indication that there was like a quote unquote loss on retiring these things of $2 per share. Okay, so that's why we're essentially debiting retained earnings, is just another way to look at this and say, these things, we paid a lot for them, more than what we initially got for them by $2 per share. We're getting rid of these things, so we're taking a hit of $2 per share on retiring these things. So just practice mechanically filling in the journal entry. That's why I recommend leave that plug figure to last. So decreasing retained earnings as if we gave investors a dividend. Conceptually, investors gave us $5 per share initially. We gave them 7 back, so you're welcome for that extra $2 per share. For us, that's almost like a dividend. So we're debiting or decreasing retained earnings with a debit to retained earnings. That's essentially kind of like what we do when we pay out a dividend. Oftentimes we debit retained earnings. Another way of looking at this. So if you're struggling with this concept, just come and talk to me, because there are a lot of different ways to look at this. But at the end of the day, we're getting rid of the shares for a higher, it costs us more to delete those shares than what we initially got. It's possible, as another option here, to resell the treasury stock. So we bought low, maybe the stock price has gone up. Let's turn around and sell it. Now, here's the thing. This is going to seem kind of manipulative. Okay. We bought these things at $7 per share. Okay. Now we're going to issue them to the market. And currently the stock is trading at $9 per share. So, okay. Step 1, empty out the treasury stock. We're getting rid of the treasury stock. So that's going to be a credit to make that go down. And that's what we're doing down here. In this case, we're not burning them, or we're basically just reselling them to the open market. So we get rid of the 7,000. Then we have to ask ourselves, part 2, how much cash did we get? So here we say, well, we got $9 per share. So plug in the 9,000. Okay. Then as a third step, your plug figure is not going to be to retain earnings. It's going to be to paid in capital. That's your plug figure. That's your third step. Now, it looks weird. In this case, we bought it at 7 and then we sold it at 9. So it seems like there was a $2 per share gain when we turned around and sold our stock. So some people say, shouldn't this credit of 2,000, shouldn't that just be a gain on sale of our own stock? And I have to say, like, no, we can't do that. That's pure manipulation. We cannot record a gain or a loss on the sale of our own shares. That's just, insider trading manipulation. So what we do is we just essentially we don't do anything to income statement. We just plug in any gains or losses to the paid in capital account. That's like our default, our reservoir in that case. A lot of people tend to make a mistake on this on the final exam. They say, well, it was a gain. And I say, economically, it's a gain. Economically, you can argue and say we got more cash than we initially paid for this. That's true. But we wouldn't record this. We wouldn't show this on the income statement as a gain. We just adjust our equity accounts. The third thing we can do is we can just issue it to our employees as a form of compensation. So stock grants are one thing we can offer. There's also stock options, which is beyond the scope of this class. We talk about stock options in intermediate accounting too, as well as in advanced accounting. So that's just an advanced topic we don't want to touch, but just realize that we can pay employees cash as a salary and wage, but we can also reward or compensate our employees in a different way. Think about it like this. If we decide to take our 1,000 shares of treasury and give it to our employees, step one, empty out the treasury stock account. That's going to go down to zero. Where is it now? Well, we just gave it to our employees. So we didn't burn these up. We didn't resell them on the market. We just gave them to our employees. You're welcome. Now, some employees would be like, okay, I like cash, though. Why don't you just, give me cash? Well, here's the thing. For our purposes, from our perspective, if we pay our employees cash for their paycheck, that would be a credit to cash. Here, why bother paying them cash if we can give them something else of value? And this is usually where people kind of think, oh, this is a good strategy here. Employees want to be rewarded, compensated for their work. Okay? How can we do that? Pay them cash or give them something else of value. If the stock is currently trading at $9 per share, then when I give them the stack of 1,000 pieces of paper, I give that to them. How will the employee view this stack of 1,000 shares? What value would they attach to this? The answer is, well, it's $9 per share. They don't know how much we paid for those. They don't need to know. All they really care about is if we give them pieces of paper, they're worth $9 each on the open market, then essentially they view the value of those certificates as $9 per share. So when we record the debit, we're going to be recording compensation expense, just like we ordinarily would salary expense or wage expense or bonus expense or commissions expense. This is another type of compensation. It's an expense, and the value of the expense is based on the market value, because that's what employees perceive. This piece of paper, I can turn around, sell it on the open market, and get $9 cash. The company loves that because that means they don't have to pay the cash. We are letting the stock market help compensate our employees. We paid $7 per share. The value that we transfer to our employees is $9. So what's the plug figure that we need in this case? It's going to be 2,000 credit. It's not a gain. Okay? And granted, we said, well, it's $9 of compensation expense. So what does that extra 2,000 represent? Well, we paid this for sure. We paid that when we bought the stock, say a month ago or 2 months ago or whenever. So that's cash that we have definitely paid. So you can look at this 9,000 that we gave them and said, well, 7,000 of that 9,000 is actually cash that the company did pay out. They just didn't pay the employee directly. They paid the previous stockholders. Okay, so that 7,000 is actual cash that the company paid out, but they didn't pay out the other 2,000. The other 2,000 is as essentially letting the stock market, the stock price, work for us to compensate our employees. We don't record a gain or loss. We just use that reservoir account paid in capital. That preserves cash. Employees are happy. We're happy. We compensated employees $9,000, but truly it only costs us in cash $7,000. It seems kind of tricky, right? But realize that this markets can go in a couple different directions too. So this is just a good strategy to reward employees. In the heyday of the .coms back in the late 90s, early 2000s, a lot of people were being offered stock options as a form of compensation. Their base pay was crap, but they got huge amounts of stock options. Well, those stock options are only valuable if they can exercise those or sell those. So same thing with stock. It's like you can give me tons of pieces of paper, but if they're worth crap on the stock market, then basically you're paying me crap and in both cash and as well as in stock certificates. So it's compensation only if the stock market's actively trading that stock. But it is a good way of compensating employees. Just as like an alternative way of looking at this in form of compensation, we could just straight up issue brand new shares of stock to our employees. So this is just, if we don't use treasury stock, but we still want to grant our employees stock, we can print brand new shares of common stock. The problem of doing that is we have to, exercise have our existing shareholders exercise preemptive right and all that stuff. So if we were to compensate using shares, we just print off brand new shares. We don't necessarily need to pull them from the market. But nevertheless, the value that employees look at is based on the market. So compensation expense that we record is based on the current market price per share. And yeah, in this case, we're just going to leave the treasury stock account alone. We're just going to issue brand new shares. Par value of $1. The remaining portion is just the excess. So employees can still sell their shares, and they're happy with that. For us, it didn't cost us anything other than printing fees, if you will. So 10.4, I want to talk a little bit about the different ways in which we can pay our existing shareholders. So we started off by talking about preferred stock. Preferred stock holders get dividends. Common shareholders get dividends. But are there any other types of quote unquote dividends or ways of rewarding our investors? Thanks for taking on the risk and investing us. Here is whatever. Dividends are cash, and those things tend to be what stockholders want. But there's another type of dividend called a stock dividend. There's also stock splits too. So let's talk about this in general. First, retained earnings is ultimately where we pay out any dividends. Retained earnings is the big bag. We can use different accounts like a dividends account to keep track of things, but ultimately just realize that if it's some type of a quote unquote dividend, ultimately it affects retained earnings. It just regardless of whether it's cash or some other form of reward to our employees or stockholders. So normally retained earnings has a credit balance. Here's the thing you need to realize. Dividends can only be paid out to the extent of whatever balance is in there. So granted, we may have net losses in some periods and those reduced retained earnings. In some periods, hopefully we have net income that increases retained earnings. But we cannot pay out in dividends that which we do not have. So retained earnings is kind of like the starting point for any company to determine what their dividend potential is. And I think in one class when we were looking at, I think it was Nike, pulled up Nike's 10K, their annual financial statement. We saw they had like $68 billion in retained earnings. They have lots of money. They have lots of dividend paying potential. So, but other companies, they can only pay out what they have. So just kind of keep this in mind. There's different types of dividends. Most of them are cash, okay? But realize that they're just distributions of equity to stockholders. Thanks for investing. Here's some of the proceeds from the profits. Cash dividends is the most common, by and large. There's no obligation. This is a key thing. I think there's an exam question about that. There's no obligation that these things be paid out. Okay, they have to be declared by the board. And the key thing is the company must have enough in retained earnings to actually declare a dividend. So if they only have, say, like $100,000 in retained earnings, they can only pay out to the extent of a dividend. They can only pay out $100,000 in dividends. Period. 3 dates that I'm always asking on conceptually on the final exam is, what do we do on the declaration date, the date of record, and the payment date? These are dividend dates. So the board will declare a dividend. That's usually how it starts. There's a board of directors meeting. They say, let's pay out 40 cents a share as a dividend. That gets recorded by the secretary. Those get recorded in the minutes of the meeting. And at that point, the company is obligated to pay out that dividend. Date of record is just filing with the SEC, and then there's actual cash payment date. So what do those look like? So date of declaration, June 19th, board declares $5,000 cash dividend. Now, companies typically will declare dividends as an amount per share. Companies can also just say, here's a bulk amount of cash that we will distribute out as a dividend. And if you're a shareholder, if you're a 5% shareholder, you'll get 5% of that. So we're just kind of talking like, here's a bulk sum of money we can pay out, and everyone else will get their fair share of it. So first things first, on the declaration date, this is a key thing, the company becomes obligated to make that payment. So the declaration date, there is an actual journal entry for that. Boom, $5,000. We're not paying cash. We're just putting in as a liability because we're calling out, we're going to pay a dividend, and we'll go ahead and debit the dividends account. We can debit retained earnings directly too, but typically problems you see on the homework and in the exam say debit the dividends account, credit the dividends payable account. If we do that, realize eventually we're going to go ahead and close that account out to retained earnings. But for right now, we declare the dividend. No money has been paid. We just said we're going to pay out a dividend. So we're on the hook. So this is a key thing people tend to miss in the exams. On the declaration date, we have the obligation, we have a liability of $5,000 in this case. Here's something else that people tend to miss. The date of record, what do? We don't do anything. There's no journal entry on the date of record. The corporation announces the record date, which follows the declaration date a few weeks later. Then the stockholders on record know that they're going to receive a dividend. So date of record, by notifying the SEC, that gets the information becomes at that point a matter of record, meaning that whoever owns the shares on the date of record are the people that will be getting the dividends. Now, could those people sell their shares? Sure, they could. Could they buy more shares? Of course. But it's a way to announce to the brokerages, if your client has any of these shares, they are entitled to X amount of dividends. So for us, we don't have to do anything. It's all just paperwork and a bunch of legalese that goes on behind the scenes. But that just gets recorded and notified to the public that people who own the shares as of this date are going to get a dividend. Nothing else happens. Payment dates, obviously, it implies there's some sort of cash payment, in which case credit cash and empty out the dividends account. So that goes down. The dividends payable goes away. Liability then goes down to zero because we pay out cash. And that's it. Those three dates are all you need to really worry about for dividends. Now, that seems pretty straightforward, but a lot of people tend to mix those dates up. So just realize it's declaration, record date, and it's the payment date, though in those orders. And there's nothing to do journal entry-wise for the date of record. Can we pay employees out in a different, or pay stockholders, who might be employees, pay them in a different way? Because this notion of paying cash, here's what the book probably doesn't tell you or make very clear. In reality, when a company starts paying dividends, it will rarely stop paying dividends. So Tootsie Roll Company, for instance, has been paying out dividends for years. Well, that's because when they started doing it, they had the cash and the retained earnings to keep doing it. Microsoft didn't pay out any dividends. They said, hell no, we just need to reinvest. We need to hang on to our cash and grow the company. So paying out dividends is costly. It's actual cash that's leaving the company and not available to reinvest in the company. But if a company is paying dividends, chances are, even though the board makes the declaration, chances are it's going to keep happening over and over and over again. And the reason why boards will continue to pay out dividends, even when the economy is in the shitter, they'll keep paying dividends because if they stop paying dividends, even for a year, the stock price will plummet. People will lose faith in investing in that company, and that's bad news. Selling the stock reduces the stock price. So Cash dividends are an expensive proposition. When companies start, they don't stop. They rarely ever stop paying out dividends. So that's cash that's committed every single year, every single quarter, whenever they pay it out. Is there another way that companies can, quote unquote, reward stockholders without paying cash? Yes. One of those ways is called a stock dividend. So, what does it sound like? A stock dividend? It means we're going to give people stock instead of cash. So, typically, what happens here is we're issuing brand new shares. New shares of stock are given to existing shareholders, and it's usually stated as a percentage of the existing outstanding shares. So if there's 50,000 shares currently outstanding and the company declares a 10% stock dividend, what does that mean? It means the company is going to issue 5,000 new shares or 10% of the existing shares out there. So the 10% times the existing shares out there means 10% more. So where's the 5,000 shares go? It goes to existing shareholders in proportion to what they own. So assume that given a proportion of existing shares owned, let's assume a stockholder owns 70% of the current 50,000 shares outstanding. So they own 35,000 of the 50,000 that's outstanding currently. So they're in control of the company. How much of the stock dividend are they going to get? How many new shares of the 5,000? How many of those new shares are they going to get? They're going to get their ratio, 70% or 3,500 new shares. That's how stock dividends work. And it may seem like there's no value to them, okay? But just realize there is value. The value is coming from the stock market. So overall, what happens? Common stock and paid-in capital will increase. Why? Because we're issuing brand new shares. When new shares are created, we got to increase common stock and probably the paid-in capital account. Retained earnings will decrease because it is, in fact, a dividend. It's just called a stock dividend. Okay? We're not paying cash, but this is a dividend that's being paid out. So overall, stockholders' equity, what happens? Nothing. And we're going to go through an example here, but just realize there's value associated with this, okay? Stock dividends, why would we want to do this? To conserve cash. That's the number one reason why. We need to make investors happy, and we also need to attract new investors. So save cash, but make investors happy, give them more stock, okay? Reduces the per share market price of the stock. And the reason why, this is supply and demand again. If this is the supply that's currently out there, realize when we issue a stock dividend, we are increasing the supply of stock, and therefore the overall market price will go down. So currently the stock price may be here. After we issue it, it will go down. Okay. Some people look at this and say, well, so it's not, the stockholder is not better off in that case. And here's what the book doesn't tell you. There's in fact a day two. So while we see maybe that the overall stock price goes down, usually by making the stock price cheaper, we attract new investors. We make the idea of investing in the company more attractive. So yes, that price, oh gosh darn it, that overall stock price is now down to here, okay? But in day two, as people start looking at this, I can now afford to invest in that stock. What you typically see is an overall increase in demand. So you'll see a shift outwards of the demand curve because people look, this is an attractive investment. So stock price eventually goes back up over time to maybe close to the original amount. So what happens here is there's a temporary decrease in the market price, but then there's a general increase back up to where investors can now sell those new shares at a higher stock price. Again, using the market to reward the stockholders. Just like we use the market to compensate our employees, we can just let the market reward our stockholders. So people can turn around and sell those stock, those new shares of stock they got, and get some cash from them. So it's all about using the market to compensate employees, and it's very valuable. There's always some question about what's a big versus small dividend, stock dividend. So just to be aware, a small stock dividend is when it's 25% or less of the existing outstanding shares. So the 10% stock dividends, that was a small stock dividend. Anything 26% or more of the existing outstanding stock, that's a large one. So declaration of dividends to be paid in stock. Company declares a 10% common stock dividend, currently 50,000 outstanding. So as we know, take this 50,000, multiply it by 10%, and that gets us 5,000 new shares. Okay, that's usually the first part of the analysis you want to do. Common stock has a par value of $1. So we have to do something with that. Current stock price is $9 per share. So what's the value of these new shares that I'm giving out? It's based on the market price. So this is not cash, right? This is in fact a dividend that we're giving out. So it's just like any other type of dividend, even though it's not cash. The credit is not going to be to cash. It's going to be to the par value of the common stock, and the remaining part goes to paid in capital. So this seems kind of, now some people are going to say, well, so you're not paying out any cash, but investors are still happy. We say, yes, they are. This works, and companies wouldn't be doing it if investors didn't like it. So just realize that we are in fact increasing the common stock account and the overall paid in capital account by whatever the market price is. But the dividends account is being reduced, it's being brought down. So there's net effect, net zero effect to the overall stockholders' equity account. We rewarded stockholders by giving them more stock, and the overall composition of our total assets, liabilities doesn't change. It's nice. It's a nice little way of compensating our existing investors. So